If you're looking to build wealth in 2025 whilst living in the UK, here's the exact blueprint on how to do it. This is what we've helped implement for our clients, what we've helped see and tried and tested over the years, so we know that it works. We've analysed absolutely every successful client that has become wealthy, and this is the blueprint as to what they've done. So stick around to the end to make sure you don't miss anything. So hi guys, welcome back to the YouTube channel. My name's Joshua Tharby. For anyone that's new here, I'm a chartered tax advisor and I specialise in working with property investors, entrepreneurs, influencers, whatever it is, basically people paying tax and helping them pay less of it. In this video, we're going to run through the exact blueprint. We've basically broken down what we've seen work for clients in terms of who builds wealth, what do they do, and we've basically copied and pasted this system and put it together for you in this YouTube video so you know exactly what to do if you want to build wealth whilst living in the UK. The first point to consider is structure. You need to have the right structure in place. When we see clients that build large amounts of wealth, they're not doing it in partnerships or sole traders or even LLPs. They're doing it in limited companies. And there's a couple of reasons for this. Obviously, there's a lot more flexibility. It's a lot more valuable when it comes to selling the business, and it's a lot more creative in terms of what can be done when setting up the company, who can be involved, and some of the tax reliefs available as well. When it comes to setting up this structure, actually a lot of our clients that we see really do build wealth. They do have a group structure. You've seen me time and time again speak about this, and the reason for this is it is the best structure when it comes to building wealth. What they do is you usually have some kind of trading company. This is the cash generating vehicle. So for me, it could be accountancy business, the accountancy businesses, the tax practices, the online education side of the business. These are all trading businesses that generate cash. For a lot of people, it might be engineering, fast-moving consumer goods, influencers, content creation, whatever it might be. You've got some kind of trading business that generates cash, and at some point, that business will generate more cash than you need to live off. So what you'll do there is with that limited company, the main trading company, that should be a subsidiary of your holding company. From that trade co, you will live out of, basically that's the company you will live out of. So you'll take income from that. If you really want to build wealth, there's kind of two levels of taxation that you need to be aware of. The first one is £50,000 of total income. That's a total, well, 50,270 to be precise. That's the total amount of income that you can earn as an individual without becoming a higher rate taxpayer and starting to pay 40% tax on that income. So if you can live off that, and indeed this is how we see some of our wealthiest clients do, actually, they've got millions in their companies, but they live a very modest lifestyle, live on that 5270 because they don't want to pay more taxes, keep everything in the company reinvested, as we're going to touch on, and actually husband and wife, 5270 each, £100,000. It's not a bad income, but it's not great. The second threshold that you want to be wary of is the £100,000 threshold, and this is what we see a lot more clients opt for because you are working hard, you've got a lot of money in your companies, and you do want to be able to enjoy the fruits of that labour. So £100,000 is the second tax efficient amount of income that you can take, because when you go over £100,000, actually you start to lose your personal allowance, which creates a 60% tax rate between £100,000 and £125,140, because for every £2 of income, you lose £1 of personal allowance. So if you really do want to build wealth, try and build a lifestyle around £50,000. If you want a little bit more, go for that £100,000 mark. And then, so back to the original topic, we've got that trade company set up. You take 50 or 100,000 pounds out, give you a decent lifestyle, and then you get your whole company up here. All of the excess cash actually gets moved over to the whole company, and then it's invested into assets, usually property, stocks and shares, crypto, or other businesses. And then you simply repeat that. It's as simple as that. You repeat that what you're doing. So you try and build as much value here, generate as much profit. You might have other ways of bringing the profits down whilst you're actually living through that business. So we spoke about salaries, £100,000, dividends. But actually you still want to do all of your main tax efficiencies through that trading company. Pension contributions, actually maximize those out. That's another thing that we see our wealthiest taxpayers do. They have a lot of money in pensions, SIPs and SASs, massive value there. They pay the children through the business as well where you can. You've got company cars. All of the holidays that they actually take genuinely are business trips as well, so that can go through, and ultimately make sure that you're putting as much through that trading company as possible, so that for one, you don't need to take the money out personally and it doesn't eat into your 50 or £100,000 income that you've taken out of the company. And then for 2, that the corporation tax that trading company pays genuinely is as low as possible. And then what will happen is at some point you'll want to exit. So you'll built a large enough enterprise value in your trading company. Usually it'll be a case of you get your EBITDA multiples, X, Y, Z, and you think, you know what, we've run this business for 5 to 10 years. Now's the time to sell it. We've got decent property investments over here. We've got stocks and share portfolio. We've got our holding company. And actually, this is how we see a lot of people get wealthy on paper, because if you to take money out into your personal name, you're paying income tax on that, 45%, 60%, whatever it is. Whereas actually, when it comes to selling a business, you can actually sell that trading company completely tax-free if it's part of a group structure. It might even be possible to do some kind of demerger prior to the sale to get that into your own name. That can sometimes be achieved. Or if you actually just looking to sell that business and you've not got a group structure set up, you can sell that. It's a capital gain, benefit from business asset disposal relief, 14% on the first million, and then just 24% after that. But for a lot of people, you've got that group structure set up. So it gives us a couple of issues here. The first is that you've sold your business, say for £5 million. You've now got £5 million sitting in the Holdco bank account, which of course is great. You know, you're very, very rich on paper, but you're probably still living off £50,000 or £100,000 a year. And then there's 2 ways to actually get this money out. So the first one is actually you can do a liquidation. This is what a lot of people do, is they liquidate that company. And then what that means is that you can basically get the capital gains treatment on the wind up of that company. Because if you've got £500,000 and you took that as a dividend, you would lose well over probably 2.3 million or so in income tax, which of course is a massive no-no. But if you wind that company up, you can benefit from the capital gains treatment. Probably won't be able to qualify for the business asset disposal relief because it won't be considered trading, but you'll only pay 24% tax on that entire proceeds. And that's the good thing about capital gains tax is, of course, there are talks about them raising this, changing it, bringing it in line with income tax. But at the minute, it's not. It's a lot lower. And a lot of the wealthiest people, they plan around capital events, not income events. Because for one, when it comes to a capital event, it's a lot more money involved, which of course makes it a lot easier to build wealth. But for 2, the tax rates are that much lower. If you've got top rates of income tax at 45% for employed income, where actually it's only 24% for capital gains, that's a massive difference that's going to allow you to build that bit more wealth. And then, of course, we've got my favourite strategy at the minute, which is where you've sold your company. You might still have that group structure in place, but actually you leave the UK. This is one of the best ways to save tax, because what you can do is when you sell that company and you've got your full 5 million in your limited company, you can simply leave the UK for 5 full tax years, take out that full £5 million as a dividend, completely tax-free, and then come back to the UK after those 5 full tax years have elapsed, and that 5 million will be sitting in your personal current account without a penny of tax paid. So that's the absolute tax win. If you compare that to what the savings would look like, if you've got £5 million at 24%, it's well over £1 million roughly in terms of what we'd be paying in capital gains tax, even if you were to liquidate the company. So for a lot of people, they actually do just leave the UK, because £1 million saving over 5 years, £200,000 a year you're being paid by HMRC to be overseas, to have that holiday. That for a lot of people is worth it. But if you did want to stay in the UK, you can basically suffer that 24%, £1 million in taxes. Still not terrible in terms of what you've been able to build. You've got your property portfolio or your equity portfolio here. You've got your whole company set up, and you might walk away with £4 million cash in the bank when you sell your trading business. This is what a lot of people are looking at doing now. This is what a lot of our clients done in the past. When we look at what they've actually done, they've built a business, they've sold it, they've done it tax efficiently, they've built investments along the side, and this is how they achieve these, crazy 7-8 figure net worths over the course of their career. What do you guys think to this? Is this the type of strategy you're looking at following? Let me know in the comments. Otherwise, see you next week. Bye for now, guys.